Getting past the 11 a.m. Eastern hour. Hello to everyone at CAPIS, friends, clients, people who have joined us for this research call. This is one of a series of monthly research calls we host here at CAPIS. I'm Ed O'Dowd. Today we're happy to have Markets Policy Partners, Brendan Walsh and John Fagan, to join us. And we're really happy to have them today. They were last with us in December, and it's good to kind of get a refresh look with them 90 days later. Things have changed a lot in the last 90 days, no question about it. And so I'm really looking forward to hearing them give their views on it. And I already talked with Brendan a little before the call, so I'm excited to talk with these guys today. And I would also say to any clients out there, let me just say right now, we enjoy giving this content to our clients, and prospective clients and friends. And if there's anyone that would like a more tailored, specific type of relationship with Markets Policy Partners, please let us know. We can get them to get on the call with you directly, craft a relationship that works for you, to kind of dive into your particular portfolio and the concerns that you have, as opposed to make it more global, which is what we're trying to do today. So with that, I was just saying it's a lot different. I know, like back in December, we talked about, you guys were talking about, and the question kind of in mid-December was, how many more Fed rate hikes will we need? Is it going to be 50, then are we going to go to 25? Like, when is this rate hiking going to end? When is inflation going to end? Still, that's a concern, obviously. But now in the last 7 to 10 days with the Silicon Valley bank failure and the fear of what's going on with the banks, considering that we do have a Fed meeting next week, 6 days from now, we're going to know whether the Fed's hiking 50, 25, or doing nothing, as some people might think is possible. So it's a good time to get these guys on the call and hear their thoughts. So with that, John, Brendan, please.
Thanks very much, Ed. Just we wanted to start out just by reviewing where our calls were in the December timeframe of last year. We went into 2023 with a view that our thesis was first quarter 2023 would be the eye of the hurricane. That we'd spent 2022 in markets getting buffeted by rate hikes and inflation, and then we would have this brief kind of period of sunshine where the Fed was beginning, the end of the tightening cycle was in sight. The top of the mountain was almost there in terms of peak rates. Inflation would be coming off, cooling, not dramatically fast, but it would be in the process of cooling. And the economy would not be in a recession as of the first quarter of the year. And we thought that this would be kind of a sunshiny period where the eye of the storm passes over financial markets and gives everybody a little bit of relief before the back half of the tempest begins to come in. And we thought that back half of the tempest would be when growth really begins, the impact, that lagged impact of tightening really begins to manifest in lower growth. It begins to bite in terms of more clearly recessionary signals. And at the same time, the Fed, even though they may have peaked out rates, just demonstrating a market unwillingness to tighten proactively into a slowdown, a very determined, stubborn almost holding of high rates. It was our thesis coming into the year. So we thought, the first quarter would be nice and sunny and relatively placid, and we would have a challenging second half of the year, but in a different way than in 2023, with inflation coming down but staying sticky and keeping the Fed very much on its toes. As of now, we have closed our. we thought that the eye of the hurricane would be a little bit longer. We thought it would be around first quarter. We have now, as of end of last week, pulled our eye of the hurricane, and we're now in at batten down the hatches mode. Clearly and Brendan will talk more about the bank situation, and we'll go to the Fed response there too. But the current events are certainly concerning and are part and parcel of our thesis that this tightening that the Fed has accomplished, the bodies are still going to be floating to the surface here, and the impacts are still to be felt. So I'll kick it over to Brendan to talk more about Silicon Valley Bank and the surrounding bank issues, and then we'll get into the Fed response that we expect.
So we don't have to go into detail about everything that happened with Silicon Valley, but basically our view is that this really shouldn't be a systemic, banking crisis. It's not a one-off issue, but because a lot of banks do have duration risk, but it's much more of an earnings issue. For Silicon Valley, they had very bad risk controls, and they took in too many deposits too quickly, and then they locked in at mark-to-market rates, a lot of MBS and treasuries, and then as rates went up much quicker than they would expected, they actually even took off their hedges. They had about $11 billion in hedges that they took off. So it really is just a story of growing too quickly, and then just not really being particularly competent at managing your asset side. And I think what the Fed did was the right way. So you can now, not just Silicon Valley, obviously they got taken over, but any bank can come to the Fed window and offer a treasury, and they'll take it at par. So it might be marked at at this point, some of them could be 80% to the par, but you can pledge that. So we just don't have a liquidity issue. I think what's happening is a little fear, and the Fed is not doing a great job of communicating to the market that this really is under control. We then had Credit Suisse, which really, the Credit Suisse issue had nothing to do with Silicon Valley or really anything. It's just Credit Suisse is a pretty crappy bank and is very badly run, and they kind of chose a bad week to remind us about that. But again, the Swiss National Bank is making a loan to them, and they're not going to go under. They can't. Deutsche Bank and Credit Suisse and UBS can't. They're the banks of the two very large and wealthy countries. So I do think that this will settle down, but it's not going to necessarily go away. For the fear with smaller and regional banks is going to remain there. So I do think we will see kind of not bank runs, but you're going to see shifting of deposits into the big five, like we are, this will probably have a macro effect, because it's the small banks that make loans to the small companies and businesses in America. So I think you're going to see a large pullback in the next couple of quarters of lending in America. The JP Morgans and Bank of Americans of the world, just if you want to start a food truck, you don't go to them, you go to your local bank or so that definitely worries me. So as you alluded to earlier, we have a Fed decision next week, and the ECB just had their decision today, and they tried to make the case that while we're both the regulator and the central bank, and they're two separate ones. So our decision today was based on being a monetary policy, and we'll work to shore up the banking sector. John, I think that's kind of what we think that the Fed's going to try to pull off next week.
Absolutely. We think the Fed's going to try to make exactly that same distinction, which is essentially the backstop to the banks and the financial stability that is being taken care of by this new facility and so forth. So and because of this new facility and its application and the regulatory response and that, we're going to wall that off to the greatest extent possible from our monetary policy. And as recently as just before the blackout period, it was actually like Friday of last week, Fed officials coming out and saying 50 basis points back on the table, the reacting to the hotter than expected inflation in January. February inflation numbers have been a little bit more mixed, a little bit more encouraging, but certainly not anywhere close to where the Fed's target is. And so our expectation is that the Fed is going to try to, is going to try to strike a balance. They're going to try to have, do both. They're not, in our opinion, ready to go on pause, especially with the kind of inflation numbers that we've seen, even though the PPI was encouraging. You saw core CPI. For every good CPI, little detail you could pick out and cherry pick, you could pick out, equally cherry pick a bad one. And so we think that the Fed is going to go try to, just split the baby on this one. They're going to go for 25 basis points, and they're going to signal, some uncertainty about rates. We could still continue to go higher. We recognize that current situations represent a tightening of financial conditions. The ECB said something very similar, which is all of our forecasts were done before this thing happened with Credit Suisse. And so I think the Fed is, our expectation is the Fed goes 25. and then signals the potential, a watchfulness. They're going to hide behind data dependence again. This has been a very reactive Fed, but they're also, you have to remember, this Fed is running scared from inflation. The Volcker, Chair Powell, every morning gets up in the morning, looks at the mirror and says, be Paul Volcker, you're the, and the echo chamber that and the sort of intellectual waters that they swim in, like the economists like Larry Summers, what are they saying? They're saying hike. You got to continue hiking. You got to fix shore up the banking risks with the facilities and all of that sort of thing. Who knows? The SEC might ban short selling of banks again. But we think the Fed is going to be very unwilling to meet this crisis with rate cuts. We think that if pressure continues, they're much more likely to pause the quantitative tightening, pause their balance sheet roll off. And we think that essentially rate cuts would be a last resort as long as they have elevated inflation. As long as inflation is still where it is, they are going to be extremely, extremely unwilling to cut too soon. That's the lesson that the Fed has taken from the 70s, this stop start. And they also are, from a bigger picture looking out, the Fed, I think, someone described what they're doing as a controlled demolition of asset prices. That's a pretty strong statement, but essentially the Fed is looking back, I think, at the, trying to take a lesson from the from 2000, basically the post-global financial crisis era, which, let's face it, the Chair Powell and the Fed did their own pirouette from 2018 to 2019. And I think they look at that and say, look, we've got, bubble crash is no way to run monetary policy, right? They want to basically exercise the demons of, the low interest rates forever. They see that this kind of dynamic that we're seeing, these unrealized losses, and these are symptoms, I think, in the thinking of the Fed of this low interest rate era. And so our expectation is that it's not just inflation. They don't want to go back to the same old playbook, which is this kind of treadmill that they've gone on before, where they ease aggressively, asset prices go through the roof, and then swoon once they fly too close to the sun, and the Fed goes into tightening again. So it's not a pretty picture. We think that Fed fund futures have been running, it's just like, it's like passengers on a ship that's tipping over. They run to one side, it tips over. So they run to the other side and it tips over. We've seen Fed fund futures, lurching wildly. Part of it is the Fed's fault. They've been rudderless in all this and haven't had a steady hand on the tiller and messaging about inflation. But, the reality is this is going to be, we think, an issue. The unrealized losses are going to be an issue. It's going to be a headwind. We're going to see a market tightening of financial conditions. We thought a relatively mild but potentially lengthy recession was going to be coming in the second half of the year. Our expectation is probably that moves up faster and goes perhaps a little bit deeper than we think. We think that in terms of fiscal stimulus, you can forget that. We'll talk a little bit about, no one's thinking about that anyway. That's not coming. And the Fed is not going to be providing the kind of monetary support that they might have in previous cycles for a variety of different reasons. That's not a pretty picture for risk assets. We think that the yield curve right now is disinverting. We think it reinverts as the 2-year creeps back up, as the Fed kind of digs in its heels on this rate hike cycle and tries to pour cold water on the idea that they're going to be getting into the rate cutting business as early as the summer. Now, the markets are, expect that financial conditions and economic conditions might call their bluff. But we just don't think that inflation is going to improve fast enough for the Fed to follow the path that Fed fund futures have right now. So that's a challenging outlook. The China growth outlook, China was supposed to be a big shot in the arm for us this year, right? We were supposed to get the Chinese post COVID zero growth miracle. And, we saw some really encouraging PMIs come out for the first part of the year. Those haven't been matched by the other data that's come out of China. We saw some pretty muted, disappointing retail sales and industrial production. Fixed asset investment was the bright side of the January, February data that came out, but that's just, that's government stimulus, and even that wasn't that great. And we've seen copper prices and the other industrial metals that got so excited, oil that got so excited about China's back in business, really have a very challenging couple of months here as they've accepted the reality that I think was hammered home at the National People's Congress when they set out the 5%, much lower than expected 5% growth target for the year. The sunshiny, glass half full expectation is that they did a cut and beat. They're like a company, cutting their cutting their targets so they can beat it. I've heard that people say that. I do not think that they operate like that. I think that they are absolutely serious that 5%, they are looking at a stable 5%. They're going to do as much stimulus as they can to keep growth from going too far below that, but they're not in the business of doing too much. Very much, I think, like the Fed's mindset now. Chinese central bankers in Beijing have been very wary of going back to the well of big monster stimulus in the face of downturns. It has created a lot of problems, as we know from the property sector, legacy debts, unrealized losses, all that stuff. And so, China is maybe a little bit ahead of us in that process of, having the central bankers, not want to overstimulate, the fiscal authorities not want to overstimulate, trying to get out of that bubble crash dynamic that has turned, the Shanghai Composite into like an EKG over the past few years, and now it's just kind of sideways dead money. And we're concerned that the outlook here in the U.S. is relatively, is an analogous kind of policy and market response. Lastly, the debt ceiling. Our view on the debt ceiling has been that, this episode of the debt ceiling is scarier than past ones. There's just, there are more. I think obviously the partisan warfare is even more kinetic this time than it has been in the past. There are voices on Capitol Hill that sound even more irresponsible on this point than they have in the past. The brinksmanship has really been dialed up, but when I was at the Treasury Department, we went through a couple of these, and one of the things that we'd heard from Capitol Hill, I was running the markets analysis unit at Treasury, and we would hear messages from Capitol Hill, particularly from Democrats, saying, it would be helpful for us to get a deal on this if markets were in bad shape. If there were other risks, if the markets were reacting virulently to this risk, then we think that it would focus minds on getting to a solution. In the current circumstances, we think that by the summertime, the U.S. economy is going to be having some issues, some more clearly recessionary signs. Financial market volatility we think is going to remain elevated, and it may not be a rolling crisis like we've seen. Maybe we're through the most acute phase of it. But there's still going to be this kind of long emergency kind of dynamic in which, small and medium-sized banks are under pressure, and unrealized losses, investors and short sellers are hunting for where are these unrealized losses. And the Fed is sitting there on its hands, unwilling to cut interest rates. And we think that with a market dynamic, the backdrop that we expect, which would be pretty adverse, we think is more conducive actually to getting a deal on debt ceiling. We think that the powers that be and the more cooler heads will say to the say to the zealots on sort of both sides, this is not the time for this kind of fight, and you end up with some sort of fudge, right? You end up with a committee to study the thing with the and both sides there's a lot of hand waving and maybe some brinksmanship and smoke and mirrors, but on the other side of it, you get both sides declaring victory and then they move on. We think that by that point in the year, they're going to have bigger fish to fry in terms of policy challenges, and but it's a non-zero risk, right? And look at U.S. credit default swap spreads in the U.S. Look at the bill yield, the kink in the bill yield. It's not a risk that we're laughing off by any stretch of the imagination. So we think that going into this process, it is going to be just another nagging headwind, and another source of risk aversion that investors are going to have to grapple with. I wish we could be a little bit more upbeat, but ultimately, our expectation is that the Fed's view that they're trying to wring out they're trying to close the book on the, zero interest rates QE era, right? And we think that that ultimately is a good thing, and that the focus and the process of getting there, it's not an event, it's a process, and the process of getting there is going to be challenging. And these are some of the costs. Things like Silicon Valley Bank are some of the costs of doing that. So we were saying before, when Brenda and I were talking, that Silicon Valley Bank, it's not obviously something that the Fed would want, but it's more of a feature than a bug in the current tightening cycle. And having, the Fed wants tighter financial conditions, they're getting them. So we'll pause there, and happy to take questions and discuss other points that we might not have covered.
Sure. So you're saying next week your prediction, if you will, is a 25 basis point hike, and then maybe kind of in a period of 25 for a while, or
Oh, we think that they pause. So we think that they go 25 and then pause.
okay.
But we think that the messaging next week is that they aren't going to signal a pause. Not clearly. We think that they'll put, they'll
It'll be a
talk about
muddled message. Yeah.
yes, they'll talk about, mixed, the impact on financial conditions. And they'll have, we're still data dependent. We've seen some things we like in the data, some things bad in the data. It's going to be just a real fudge, right? And they're going to give themselves maximum optionality for the next meeting. We think that optionality will ultimately lead them to a pause at the May meeting. But that is also, it's like a long time. It's like a long way away.
Yeah. They probably, they probably would like to pause, but they've painted themselves in such a corner that they would lose so much face if they did. And then I think by saying they're going to be data dependent, we think that the data is going to justify them pausing in 2 or 3 months' time.
Okay. I hope you're right. All right. Well, thank you so
Yeah.
much. If anybody has a question from the audience, please enter it into the chat. Don't know that I see any questions right now. But if there's any questions at all, please put them into the chat at the bottom. I think you guys did such a good job hitting all the points that there wasn't any questions. I mean, the question I had was obviously, and I knew you were going to hit it without me asking, is what is your call for next week? That was an obvious, but then kind of your thoughts going forward. And yeah, a pause. Interesting.
Yeah, a pause, but we think that the pause might refresh. But when the Fed stays on pause and refuses to signal cuts, like by the summer, the backdrop, we think in the economic backdrop will be, relatively more adverse, and they're still going to be, manifesting tightened financial conditions and elevated volatility. And we think that the Fed is going to be very stubborn and very unwilling to put rate cuts on the table until we're really in the teeth of a recession. And by then it's too late.
Yeah. I mean, just look at the oil markets. It's been going down for basically the entire year, and now it's at levels we haven't seen in a long time. And I feel like that's an under talked about data point.
Okay.
Yeah, and that feeds back to what we said about China. We're just not that positive about Chinese growth. They
just don't really care.
It's been a mirage. And every time they say they're done with the common prosperity, they're done beating up on the private sector, they beat up on the private sector again, right? And it's through one sector, the other. They don't care about economic dynamism. They care about basically like self-reliance. And
so you're certainly not bullish on Chinese equities.
No, absolutely not.
Okay.
We think that we thought that there would be some outperformance in the first half of the year on the back of this COVID and the stimulus, which would be, it would be better than they'd had. And the Chinese stocks have been beat up so badly. But our view on the medium term for Chinese stocks is just dead money, right? It's just going to go nowhere. And when you have, I think that essentially the investing public has awakened to the idea that, hey, these companies may be dynamic, but they are beholden to a government that is, they have no enforceable property rights in their own home market, none, other than what the Chinese Communist Party decides to grant them. And that's, that's just a fact. And we've whistled, we've sort of papered over that risk, but now that risk is manifest. And we think that, you can always find a trade, right, in Chinese stocks. They'll bounce off the bottom on stimulus, but it's not something that you want to put in your portfolio for the long term.
Yeah, and it looks like the Biden
in our
administration is going to go through with this ban on TikTok. So there's certainly going to be a response from China. So figure out which company is going to get banned.
Being based in Washington, D.C., there's just no sign on either side of the political
Right.
spectrum to go easy on China, or to do anything other than continue to tighten the restrictions on tech transfer and so forth. This is not something that people are going weak in the knees about, and there's there are obviously debates about how to manage the relationship in a more constructive way, but this is a really challenging moment geostrategically for the United States. Like watching China come out and like broker a peace between Iran and Saudi, that is not something that the U.S. diplomatic corps is excited about, and it creates a lot of heartburn and concern. And I don't think that whether you're talking about the national security establishment, the Commerce Department, the USTR, the White House itself, an incoming administration, you pick what that incoming administration in 2024 might look like. None of these formulations are going to be a wholesale backing down on the policy direction of China, which is just more companies taking and removing their taking their operations out, risk management. It's just you have to do that in this day and age. It's just the prudent thing to do.
All right.
Yeah, I mean, Mark Mobius saying I can't get my money out of China.
I saw that. Yeah,
right.
It was, I think, from HSBC Bank actually.
Yeah.
Yeah.
So again, the U.S. government can say this and that and the other thing, but essentially Beijing is making the points that the U.S. government is making even more clearly than the U.S. government is. So it's
Absolutely. Well, gentlemen, thank you so much. We really appreciate your perspectives today and your guidance. And again, like I said earlier, it's so timely to have you on for this call with what's going on next week and really the next 90-day outlook. And we look forward to having you on again in the near future, obviously. And like I said, if any clients that are on the call would like an introduction to John and Brendan, we can make that happen. So just let us know.
Yep.
And appreciate
We're
it.
always around.
That's great. Yeah, we're on marketspolicy.com. You can check us out on YouTube. We have fantastic webinars with really exciting guests, and we'll look forward to any questions and calls and follow-ups. Thanks so much, Ed.
Oh, you got it. Thanks, Brendan. Thanks, John. Thank
Thanks,
you,
Fagan.
CAPIS clients. I appreciate you joining us on the call today. And everyone have a great day, and we'll talk to everyone soon. Take care. Bye-bye.